Ladies and gentlemen, welcome back to the channel. Today we're breaking down the dramatic market reaction to the US and Israel strikes on Iran. A story that is still unfolding right now, and the effects are already roaring through global markets. This is not a drill. The situation is extremely serious and has already pushed oil prices, gold, stocks, and geopolitical risk indicators into highly volatile territory. This weekend, on February 28, 2026, the United States and Israel launched a coordinated military operation against Iran, reportedly targeting senior leadership and strategic facilities in Tehran and other cities. Israeli and American officials say they aim to neutralize Tehran's capability to threaten US and allied forces in the region. But the consequences extend far beyond military objectives. Immediate market reaction right now. Markets are reacting sharply. Oil prices have jumped to multi-month highs as traders price in the risk of supply disruption in the Middle East. Brent crude is trading significantly higher and has already reached around $72, $73 per barrel, with analysts suggesting it could head toward $80 if disruptions escalate. Crude shipments through the Strait of Hormuz, the vital chokepoint for about 20% of global oil flow, are already being suspended by some oil majors and traders, amid fears of attacks or blockades, which could dramatically cut supply. US stock futures and indices have weakened as investors reduce risk exposure. Equity markets, especially in energy-sensitive and cyclical sectors, are under significant pressure as traders shift capital to safe assets. These reactions underline a core truth about markets: uncertainty drives volatility. Investors are actively rebalancing portfolios as fear premiums rise. While oil and energy markets are at the forefront, the Middle East is the world's most critical energy hub, and Iran plays a central role not just as a producer but as a player influencing global supply dynamics. Although Iran produces around 3 to 4% of world oil output, a conflict involving its infrastructure or transport routes could have outsized effects on crude prices because alternative supply cannot immediately make up the difference. Even before this weekend's strikes, oil markets were already sensitive to geopolitical risk, with Brent having climbed to recent highs as traders factored in tensions. Now, with the potential for real supply disruptions and suspended tanker traffic through Hormuz, analysts are openly talking about Brent prices approaching $80 per barrel or even breaching $100 per barrel if the conflict expands. This is important because higher oil prices don't just mean energy companies make more money, they translate into higher costs for transport, goods, and inflation pressures worldwide. That feeds directly into equities, consumer sentiment, and central bank policy considerations. US equities and risk sentiment. US stock markets were already showing volatility going into this weekend. On February 27th, just before the crisis, the major indices posted losses amid inflation and AI sector concerns. The S&P 500 was down, the Dow dropped over 1%, and the Nasdaq also slid. That kind of weakness sets the stage for sharper reactions when geopolitical risk spikes. In times of heightened tension, beta and growth stocks tend to underperform. Defensive sectors and commodities like gold, utilities, and consumer staples usually outperform. Safe haven assets like gold and government bonds attract inflows. That's exactly what markets are displaying. Right now, risk assets are sliding while safe havens benefit from capital inflows. Gold and safe havens. Surge gold has traditionally been one of the go-to assets in times of geopolitical stress. With all these developments unfolding, gold prices are trading higher as investors seek protection from market uncertainty. This demand is partly because gold does not carry credit risk, and partly because it is priced globally and reacts quickly to shock events. Metals like silver and platinum also see increased interest, especially as industrial demand is repriced amid supply tensions. Metals don't always spike as sharply as gold, but they benefit from the same safe haven sentiment and inflation hedge logic. What could happen next? So let's talk about what might happen over the next few trading sessions, weeks, and possibly months. Oil prices could surge or swing sharply if shipping through the Strait of Hormuz is significantly disrupted or if key energy facilities are damaged. Brent could move past $80 per barrel, possibly above $100, especially if the conflict widens to other Gulf producers. Higher oil tends to widen inflationary pressures, potentially forcing central banks to reconsider rate expectations if energy costs rise rapidly. Stocks could enter a prolonged risk-off phase in a full risk-off environment. Equity volatility spikes. Correlation between asset classes increases, and traditional diversification becomes less effective. We could see extended weakness in US and global equities until the geopolitical situation stabilizes. Safe havens might get even stronger if fear premiums continue to dominate. Assets like gold and treasury bonds may climb further as investors reduce exposure to riskier stocks and commodities. This could persist until some clarity on the conflict's duration and outcome emerges. Metal market direction regarding metals. Precious metals could continue higher if uncertainty remains. Gold and silver typically benefit most directly from flight to safety flows. Industrial metals like copper and nickel may remain volatile, rising or falling based on how the oil shock affects global manufacturing costs. Final takeaway in summary. We are in the early stages of a complex geopolitical shock that is reverberating through global markets in real time. From oil and stocks to metals and safe havens, markets are pricing in a wide range of scenarios from rapid escalation to prolonged conflict. At the core of today's movements is uncertainty, oil prices surging on supply risk premiums, equities weakening on risk-off sentiment, and safe havens strengthening. What happens next will depend heavily on whether the conflict expands or if diplomatic channels manage to slow the escalation. We will continue to bring you minute-by-minute updates and detailed market analysis, so make sure you hit that subscribe button, ring the notification bell, and comment below.